Hello, everyone. My name's Justin Miles. I'm one of the education specialists here at CareSuper. I'd like to welcome you all to our Be Payday Super Ready webinar, where we're going to explore the insights into your super guarantee obligations and responsibilities. Now, joining me today, I have Shane Moore from the Australian Taxation Office, who is the Project Director of SuperStream and STP improvements, Payday Super implementation, and super and employer obligations. Now, before we begin today's session, I'd like to start by acknowledging the traditional owners of the country throughout Australia and acknowledge their continuing connection to land, waters, and community. I'd also like to pay my respects to elders past and present. Now, it's important to remember before we go into today's webinar that all of the information presented today is general advice only, and it's not taking into account any personal circumstances nor making any form of recommendation. You should consider the appropriateness of the information that we present today and consider the product disclosure statements, target market determination documents, or even seek financial advice before making an informed decision. Now, today's webinar is being recorded, and by joining today's webinar, you are giving consent to being recorded. And a copy of today's webinar will also be put up on our dedicated Payday Super website on the CareSuper page. Now, we also have a Q&A function available at the end of today's session. So if you are joining us and it's your first time using the Zoom functionality, down the bottom or up the top, depending what device you're using, you will see a little Q&A function where you, throughout today's session, can submit a question just by hitting enter, and those questions will come through, which I'll join Shane at the end to read through. Now, it's important in today's session that we'll be covering the legislative changes coming into effect 1 July 2026. If you have any questions about making payments or systems, we will address these questions on our dedicated Payday Super webpage on the CareSuper public website, as well as future correspondence as we move closer to 1 July 2026. You can also reach out to your dedicated relationship manager or business partner manager should you have any questions. And lastly, at the end of today's session, we will send out a feedback survey, just allowing you to give us insights into what worked from today, what else could we do, as well as getting in touch, formally a request to speak to someone at CareSuper, such as your relationship manager. But I'd like to welcome Shane Moore to kickstart today's Payday Super webinar. Now, Shane leads the ATO's core Payday Super initiatives, including enhancements to SuperStream and changes to single touch payroll. With a strong track record of delivering complex reforms across the superannuation system, Shane brings deep technical experience and practical collaborative approach. He's known for building trusted relationships across industry and government and brings a personal touch when dealing meaningful change. So Shane, welcome to today's session. Thank you so much for being here today.
Yeah, thanks, Justin. It's great to be with you here today. So today, my aim is to give you a brief overview of the Payday Super changes and the key changes and what they mean for employers. So Payday Super has been announced to commence on 1 July 26, and legislation was introduced on the 9th of October in relation to the core changes expected in relation to the super guarantee obligations and the super guarantee charge. Now, there are still some things expected to follow via regulations, which will further define the new obligations on employers and super funds. These support the changes that were outlined in the initial government's Payday Super fact sheet and the exposure draft law released in March. So the government first introduced the concept of Payday Super on the 2nd of May 2023, with plans to bring it into effect from the 1st of July 2026. Then, on the 18th of September 2024, government outlined the next steps in implementing Payday Super. An exposure draft and explanatory materials were issued by Treasury for a 4-week consultation period on the 14th of March 2025. Submissions closed to the exposure draft on the 11th of April this year. At its core, Payday Super is a simple concept. Just pay super when you pay wages. If only it was that simple. There are a lot of connected parts in the SG ecosystem, which makes it complicated. With employers, digital service providers, gateways, clearinghouses, super funds, and the ATO, we all need to make changes that support the implementation of Payday Super. Ultimately, Payday Super is aimed at ensuring the more of the $6 billion in unpaid super guarantee each year makes its way into people's super accounts, improving the retirement income of millions of Australians. Bills for the core components of Payday Super changes were introduced into Parliament on the 9th of October this year. The bill passed through both houses with some debate and some suggested amendments, none of which were accepted, and the bill has now received royal assent, locking in a start date of 1 July 26. So what are the key changes? The timing of contributions of super is changing from quarterly payments to payday payments. From 1 July 26, employers will need to ensure they make super guarantee contributions at the same time they pay salary and wages. This means contributions will need to be received by the super fund within 7 business days of payday. If contributions aren't received by the employee super fund within the required timeframe, then an employer could be liable for the super guarantee charge. The super guarantee charge is also changing under Payday Super. Now, there are some exceptions to the standard 7-day business rule for contributions. Employers will have additional time to make super guarantee contributions where it's the first time they've made an eligible contribution to a particular super fund for the benefit of that employee. In these scenarios, you need to make sure the payment is received in the super fund within 20 business days of payday. An eligible contribution will be applied to reduce any individual base SG shortfall if it's made before the end of the 20th business day after payday. Now, this is known as the extended usual period. This extended usual period applies for the first payment of SG after an employee has commenced employment with the employer, or even if the employee had previously worked for that employer, ceased employment, and then recommenced working for them. This is to accommodate for the additional time it may take to onboard a new employee, get all the information an employee needs to make a superannuation contribution to a fund. The extended usual period also applies where there's an eligible contribution to a new super fund for an existing employee. Now, this is intended to cover circumstances where contributions are made to a different fund midway through their employment relationship. Now, this can occur for various reasons, including where an employee makes a new choice of fund, or where that chosen, stapled or default fund is not able to or becomes unable to accept an eligible contribution for the benefit of an employee. Another example could be where there's a super fund merger or a transfer. The extended usual period does not cover an employee taking a period of leave, including any extended period of leave, if there is no change to that employee's super fund when the employee returns from their period of leave. Several examples are included in the explanatory memorandum to assist understanding of the intended application of this extended usual period. These extended due dates are built into legislation to provide flexibility where it's genuinely needed, without compromising the intent of more timely super payments. There's also an extended period for out-of-cycle payments, and the Commissioner can make a legislative instrument to determine what kinds of payments are included and what the requirements are. Some examples may include things like commissions and back pay. This means where it is an out-of-cycle payment, the employer has until the end of the next period to make a contribution in relation to that out-of-cycle payment. Finally, if the Commissioner has issued an exceptional circumstances determination, for example, due to a natural disaster, under those determinations, employers will have up to 20 business days to make a contribution. So another key change is exactly what is payday in the context of Payday Super. It is the date that an employer makes a qualifying earnings payment to an employee. This is the foundational concept introduced in Payday Super policy, and is to be used for calculating both super guarantee contributions and the super guarantee charge. Contributions will generally need to reach an employee super fund within 7 business days of a QE payment. So what is QE? QE sounds new, but it really brings together into one term a number of different superable amounts that are separately dealt with in the current law. The introduction of QE does not fundamentally change the calculation of the minimum super guarantee contribution an employer must make to avoid becoming liable for the super guarantee charge. If we were to define QE, it includes payments from an employer for their employees that are already OTE, such as payments for ordinary hours of work, most paid leave, most allowances, bonuses and commissions, and most lump sum payments. With the exception of commissions, if these amounts I've just mentioned are not already included in current OTE, then it's not QE. For example, things like paid parental leave and workers' compensation is not OTE and it's not QE. QE also includes any amount that would otherwise be QE but has instead been salary sacrificed to super is included in the calculation of an employee's QE. And amounts paid to people that are treated as employees for super guarantee purposes, such as contractors, sports people, and statutory office holders. Now, the key difference between OTE and QE is that QE includes all commissions. Whilst the ATO accepts under current law that commissions paid solely for work performed entirely outside ordinary hours of work are not OTE for the purpose of the Super Guarantee Administration Act, they will be included in QE. Now, QE will also include amounts paid to employees under the expanded definition of employee under the Super Guarantee Administration Act that are not OTE for the purposes of that Act, like independent contractors who are considered employees for super purposes. Now, QE does not include any of the following: any amounts excluded from QE by regulations, and any amounts that exceed the maximum contributions base. There's also a change to the maximum contributions base. It will no longer be a quarterly base and changes to an annual maximum contribution base from 1 July 26. So what won't change? The types of payees reportable in STP on single touch payroll are not changing. For example, reporting of contractors will remain voluntary. Now, there is a change to a single touch payroll from 1 July 26. The ATO is updating single touch payroll to include a new code for QE, to code Q, and this will require reporting of both QE and super liability through STP reporting each payday from 1 July 26. Now, the ATO is working through this with our Payday Super technical working groups on how these changes can and will be implemented in STP software and what DSPs need to do. We recommend you reach out to your payroll DSP to understand what their plans are and to get further information that they can share with you to start getting ready for this change. So how are qualifying earnings different to ordinary time earnings? For your information, we have published enhanced employer guidance to help employees understand OTE for the purpose of the Super Guarantee Act. We'll also be updating this page and fact sheets to help employers understand what is QE to get ready for these changes. So the Super Guarantee charge also changes under Payday Super. There's a new method for calculating the Super Guarantee charge, including the allocation of late payments. There will no longer be a late payment offset for payments made after 1 July 26. The Super Guarantee charge has been updated to better align with more frequent payments of Super Guarantee due to Payday Super. There are several components that have been adjusted. Firstly, there's now an individual final Super Guarantee shortfall that is any unpaid Super Guarantee at the time the Super Guarantee charge is assessed. The individual's final shortfall will now be calculated based on qualifying earnings, which brings it in line with how Super Guarantee contributions will be calculated. Where an employer makes a late contribution before the Super Guarantee charge is assessed, that amount will reduce any individual final shortfall. It's important that the ATO does encourage employers to make late payments to the super fund as soon as they're aware before the ATO makes an assessment to reduce this shortfall. The next is notional earnings. This is essentially interest to compensate employees for lost fund earnings when the contributions have not been paid. It's calculated daily at the general interest charge rate on the individual final shortfall and stops accruing when that shortfall has been paid. Then there's also an administrative uplift. This is an extra charge to reflect the cost of enforcement and encourage employers to make voluntary disclosures to the ATO. There's also a choice loading. This applies when an employer doesn't comply with the choice of fund rules. The choice loading limit will increase from $500 per notice period to $1,200 per notice period with no discretion on the ATO to reduce. Once the Super Guarantee charge is assessed, if it's not paid in full, additional interest and penalties may apply. This could include a general interest charge, will apply on the entire Super Guarantee charge amount, not just the individual final Super Guarantee shortfall. Now, if the Super Guarantee charge remains unpaid 28 days after the assessment has issued, the ATO must issue a notice to pay. If the employer still doesn't pay within another 28 days of that notice, a late payment penalty will apply. Now, the Commissioner cannot remit a late payment penalty in part or in full. The general interest charge does not accrue on late payment penalties if they are unpaid. There will no longer be an obligation on an employer to lodge a super guarantee charge statement. Instead, an employer can lodge a voluntary disclosure statement. They should pay these amounts to the fund as soon as possible, not to the ATO. Another important change is that the super guarantee charge will now be tax deductible, which brings it into line with the treatment of regular super contributions. To be clear, any penalties and interest after assessment of a super guarantee charge are not deductible. The changes to the late payment offset do not apply to amounts after 1 July 26. This means that the last quarter employers can have a late payment offset applied is payments in relation to the March 2026 quarter. Employers will have until the 28th of July to make their on-time contributions for the June 26 quarter. The payments made after 28th of July 2026 will be allocated to the Payday Super regime and cannot be used under a late payment offset. Under Payday Super, late contributions will be applied to the earliest QE day where there's an individual final SG shortfall that's greater than nil, provided the employer has not already been assessed for super guarantee charge for that QE day. The late contributions receive the individual final super guarantee shortfall for the relevant employee. This is necessary to reduce complexity and uncertainty in administering the laws. So the ATO is making some important changes to update systems and processes across the superannuation ecosystem that will support Payday Super. The key change will be around single touch payroll reporting. Employers will need to report amounts for both employees' qualifying earnings and superannuation liability via the STP-enabled software from 1 July 26. This will help ensure the correct super guarantee amount is calculated by the ATO if we are raising super guarantee charge assessments, make it easier for the ATO to detect when super hasn't been paid and engaged with those employers earlier. So it's important that employers check when their payroll software will have this new field available to meet the new reporting requirements from 1 July 26. While software providers are getting ready, employers should start thinking about how their software treats amounts that are qualifying earnings and super liabilities today. Start reviewing how pay codes are mapped in your software and get ready for this change. There are also updates coming to the SuperStream data and payment standards that look to support the higher volumes and faster timelines of Payday Super. This will include ensuring that all super funds must accept payments made through the new payments platform by 1 July 26. This allows for faster payments of super contributions between employers, through the service providers and clearinghouses and onto super funds. Error messaging will be improved to ensure employer clients can better understand why a contribution was rejected and what they need to do to fix it. There'll be a new message in SuperStream called a member verification request, which can be used by employers to confirm an employee has account details in a super fund before paying a contribution to that fund for the first time. The MVR is like a digital handshake between an employer and a super fund, confirming they have an account for that employee and will accept a contribution. The MVR will significantly reduce common errors that happen today, when 98% of rejected payments today are due to funds being unable to match a member or the member has left the fund. To align with Payday Super changes, super funds will have new timeframes under regulations which we know are still to be released. They will have less time to resolve issues with contributions. So if a contribution can't be allocated, for example, due to incomplete employee or member details, super funds will need to return that contribution back to the employer within 3 business days of receipt, which is reducing down from 20 business days today. This will mean funds will not have the time to contact employers to do the work to work through data issues or capture missing information, and we expect this could mean more rejected contributions. According to ATO data today, 80% of contributions are reported to the ATO by super funds within 3 days of receipt. So it's important employers check their data and look at any errors they receive today in anticipation of making changes for Payday Super. Additionally, changes to choice of fund rules have been announced that will allow employers to request and show an employee their stapled fund from the ATO as part of an onboarding process. It is designed to reduce the risk of duplicate accounts and makes it easier for employees to stick with their existing fund if they choose to. So now let's talk about the Small Business Super Clearinghouse and what's changing. As part of Payday Super, the Small Business Clearinghouse will be retired from 1 July 26, as it will no longer be fit for purpose under the Payday Super regime. That means from that date, we will no longer accept contribution payments from employers through this clearinghouse. If we're to be honest, anyone familiar with the Small Business Clearinghouse will admit it does not sort employees, there's no file upload, and everything has to be entered manually. It is time, has served its purpose, and it's now time for a dignified retirement in readiness for Payday Super. What we can tell you is there's around 250,000 current users of this clearinghouse, and most of them pay quarterly. So since the 1st of October 2025, new users can no longer register for this service. Existing users can continue to use it up until 30 June 2026. And we're encouraging anyone using the Small Business Clearinghouse to start transitioning now. Now, this might mean reviewing your current payroll software, as many of these payroll services already offer super payment functionality within existing subscription packages. Check what your super fund offers and also look at commercial clearinghouses. We're suggesting they speak to the registered tax professional to make sure they're set up for success. The key message on the clearinghouse is don't wait until July 26. Start planning now for how you'll meet your super obligations once the Small Business Clearinghouse is gone. So what can employers start doing now? Employers can look to move paying super into a more frequent process. In fact, many employers already pay super more frequently than quarterly today. So speak to your payroll provider, your tax professional, or your super fund for more information and start to get ready for the 1 July 26 start date. When the Payday Super bill was tabled in Parliament, the ATO at the same time published a draft practical compliance guide that outlines our approach for employers in that first year of Payday Super. Now, this practical compliance guide sets out the factors that will be considered when deciding how the ATO will apply our compliance resources to investigate employers in relation to QE days, payment of SG in that first year of Payday Super. This proposed compliance approach will recognise that employers who try to do the right thing 1 July 26 and resolve issues quickly should not be the focus of the ATO's compliance action. The ATO will take a risk-based approach on employers who have taken a genuine attempt to comply. This practical compliance guide was open for feedback for 2 weeks, but closed on the 7th of November. The ATO is considering all the feedback we received and will publish our final practical compliance guide soon. So to summarise, the key takeaways from today's session, it's important to understand how the proposed Payday Super changes may affect employers. Employers will need to ensure they make super guarantee contributions at the same time they pay salary and wages from 1 July 26. And there's nothing stopping them from transitioning to a more frequent payment cycle now to help them to get ready. There's a new concept of qualifying earnings that is used to calculate both the super guarantee contributions that are paid and the super guarantee charge. Employer clients will need to learn about QE, and more information is on its way. And don't forget, this will also need to be reported through STP. Software providers are currently looking at what this means for software products, and they'll be in touch with their clients once they know what these changes look like and what their implementation plans will be. The design of the super guarantee charge will change on the Payday Super. There's a new method of calculating this charge, including allocation of late payments. More information will be coming on these changes that are being made that will support and reduce errors in the system between employers and making contributions and funds being able to accept them. The Small Business Clearinghouse is closing, and the time to start looking at alternate options is now. People don't need to wait until 1 July 26 to start making these changes either. So thank you for your time today. I think now I'll be handing over to Justin to start taking time for questions.
Thank you, Shane, and thank you for going through all of the changes around Payday Super. It's a lot to take in, and there's a lot of changes, but there's a lot of support out there. Just need to ask those questions, which absolutely leads us into our Q&A section. So we've had some questions come through, but for anyone still have a question and digesting what Shane has gone through, use that Q&A box down the bottom, submit a question, and we can go through it today. But again, a friendly reminder, if your questions are more around making payments or systems, again, it's not something that we'll go through today, but we will have that Payday Super page for CareSuper as a dedicated resource. But Shane, the first question, if I may throw to you, is do I have 7 business days to pay return super or just pay it on the next pay super run?
Yeah, thanks, Justin. So the obligation on an employer under Payday Super is to have that contribution received in an allocatable form in the super fund within 7 days of payday. So any rejected contribution that goes back to an employer, the clock started on payday. So unless there are extended due dates apply for new employees, or you're paying to a different fund, if the contribution is going back to the same fund, or the time frame the employers have to work to is 7 days from that payday. So employers do need to factor in and allow that those things could happen, that returned payments could come back. And if they are after 7 days of payday, then obviously employers need to consider whether they have to lodge a voluntary disclosure statement for being late. But the 7 day rule does apply from payday, irrespective of whether errors are made.
Now, another question similar to, I guess, time frames. So the question is, employees have 28 days to supply their tax file number. How does that reconcile with the new requirements?
Yeah, so the tax file number requirements still occur as they do today. There are ways with which you can send substitute TFNs or default TFNs through the contribution process. Ordinarily, not having a TFN or in an onboarding process, we would have the extended due date apply under Payday Super. So it does take into consideration that employers, it takes longer when you're onboarding a new employee to get all the information you require. So all things, working efficiently, hopefully any employee who's applying for a tax file number while they're also starting for their job would have got that tax file number before you need to pay a contribution. However, a contribution can be paid to a super fund while a person is still in the process of applying for that TFN. The fund will still accept the contribution. There are ways with which your payroll software and your packages can send these messages without TFNs, or that the TFN hasn't been quoted. Or you can use relevant default TFNs within software that shows that it has been applied for, and the super fund can still receive and allocate those contributions. So the key message there is, even when there are other peripheral things required, the need to send a super contribution does commence within the relevant timeframe from payday. And the key message would be pay the super within the due date so you don't become liable for the charge.
Thank you. A question is there any information available on how an employer can tackle overpaid super?
Yeah, at the moment, the best way to tackle that problem, and we do acknowledge it is a problem. We are still trying to navigate the best way to resolve that, as funds deal with that in a different way. Our main message to employers is talk to your super fund, your default super fund, and understand what their processes are, and how do you get back overpayments from those super funds. And particularly, your super fund is the best source of truth as they control the process. And any forms or information you need to provide to them, they would be the best source of truth. The Payday Super bill does contemplate overpayments, where they can just be allocated to the next QE day. So if that individual does remain in employment, an employer can pay less on the next QE day in relation to the next super guarantee payment, to use it as a bit of a running ledger in terms of amounts they need to pay. Which is okay when the employee does remain in employment. We appreciate there are circumstances where an employer may want to get that money back because they have ceased employment. So they follow that current standard practice as they would today to get overpayments back. But the ATO does acknowledge that this is potentially an increasing problem in Payday Super, and we do need to look at if there's any things we need to do to improve these processes, that we are talking within our working groups and also with APRA on these matters.
Can see a question's come through about two times, almost identical in the way it's worded from two different audience members joining us around. So, what should we do if an employee changes their super fund, doesn't notify you, and then their contributions returned to the employer?
Yeah, so obviously, in relation to that, there is an extended due date that does apply in those situations where the employer does need to pay the contribution to a new fund. Um, there is one course of action where the employer can use the stapled fund service from the ATO to find out, well, where is this person's account? There's also updates to the fund validation services that will give some early notice of key changes to, like where there's a merger or a successor fund transfer. That will give some early warning those things are happening, because that is probably one of the most common reasons outside an individual changing their fund and not telling the employer, where funds merge. That does cause some issues there. So there'll be ability to track that in your payroll software, that these things are coming, and if you haven't figured that out until you've already made a contribution, then there should be a way to trace where the new fund has gone. But the key thing is to talk to your employee who's received that returned contribution for, and find out, well, where is their new fund? If you can't access the stapled fund service, then they should be able to give that to you. And if not, of course, if you can't get that information from the employee, then the employer can always take the path of paying to their default super fund to meet their obligations. The clock's still ticking, so employers need to, do what you can. But at the end of the day, if the employer's not engaging with you, you're not getting the information you need, then you're within your rights as an employer to pay your default super fund.
Might jump to a question 'cause they are coming through, but just something that you mentioned really go into the next question around mergers, because I can see questions come through around what happens when there is a merger between super funds and then there's a blackout period. Obviously, when trying to make payments, there's a blackout period during those mergers.
Yeah, we do acknowledge that is a sensitive issue today. And there have been quite a lot of mergers in the last few years. I guess there's been varying limited service periods or blackouts across these mergers that have impacts on employers. So the ATO has been in regular conversations with APRA about the importance of maintaining continuing ability to accept contributions, appreciating that mergers are complex, and they don't happen that often, but when they do happen, it is an impacting change, and it's a breaking change at times. So the ATO's preference is that there is no blackout period, but how we get there is probably a bit of a journey now, with obviously the ATO, APRA, and industry, to figure out how do we best navigate these processes to limit the impact on employers. Because there is a grace period written into the Payday Super bill that does give employers this 20 days, where there is obviously an extended due date when the contributions have to go to a new fund, which has been pulled into the bill in anticipation of the impact of a merger. That extended due date should help employers have sufficient time to navigate between the old fund and the new fund.
Thank you. A question comes through. What happens when paying wages in advance? So if there is that kind of advance pay cycle.
Yeah, so the requirement to pay super guarantee on payday all goes to the nature of the payday itself. So if it's a payment in advance for wages, then it still would be considered to be a QE day, and a SG payment will be made. Then if there's any adjustments, then that can be washed out based on the next payment post that, to make sure the right amount's being paid over the full QE periods.
Thank you. Will there be changes affect SuperStream SAF files, specs used to upload to clearinghouses?
Yeah, there are no fundamental changes to that alternate file format. The only changes the ATO has considered or put into the SuperStream standard are the inclusion of pay IDs, where an employer can choose to use pay ID as part of fast payments to receive returns, or to obviously make payments. But that data point itself can be just discussed with the clearinghouse or payroll, as it's a one-off data point. So it doesn't need to be passed through with every SAF. That you can talk to your clearinghouses and your providers to navigate that part of the change. But the fundamental structure of the SAF has not changed at all in relation to our SuperStream changes. That can continue as it is today.
A question is there a grace period for correcting errors before penalties start applying?
The only grace period that sits within the Payday Super bill is where an extended due date applies. And of course, that means the first time you're paying a contribution to a new fund for a new employee or due to a change of fund. If it is an error that's come back from a super fund and then subsequent remediation happens with the employer talking to the employee, that then goes back to the same fund. If there was no extended due date applicable, then 7 days is the due date that applies to that returned contribution.
Thank you. Are you able to go through more detail around the changes to the MCB to an annual amount rather than the quarterly amounts?
Yeah, so that means obviously shifting from quarterly to annual, the base is the same. It's just shifted to a quarterly base. So once an employer hits that annual base, they don't need to continue paying super guaranteed contributions. With a shift, obviously, with a move to a payday frequency away from quarterly, then employers just need to factor that into their payroll systems about when they can choose to stop paying super guaranteed contributions for those individuals who do hit that base at that point in time. But of course, as it's an annual base, it could happen at any time in that year based on that employee's income and the contributions that are paid. But it's just something employers have to factor into the payroll systems about when those individuals hit that base across a year as opposed to across a quarter.
Thank you. And I think we've got time for two more questions, if that's okay. But I can see similar questions coming through, which is fantastic. Ones that we've already answered. But just second last question, if I may. So will there be any changes to the superannuation guarantee employer shortfall exemption that employees request through the ATO?
That would be a quick answer for me on that one, Justin. That process remains as it does today. Employers can still choose to lodge an exemption certificate in the same process with which they'll do today. So no changes to that one.
And last one is we currently project superannuation on payments such as bonuses. Ours have SGC inclusive in a quarter as we pay to the MCB. How is this going to work in the new MCB if it's annual? I know you touched on that, but just very specific.
Yeah, it's probably the answer to that one, Justin. We just need to be factored in terms of how this sits across the entire calendar year, entire financial year, I should say, not calendar year. As the adjustments just need to be made on, well, where is the base? Where does it fall in terms of that person's contribution cycle and their payments of their wages, etc. So something you just need to figure out, where does that interaction occur, and then how they make the relevant adjustments to their payments in their systems to deal with it. So instead of having to do it every quarter, you now do effectively that once a year when it hits. Is just something to consider in that shifting and flattening across the whole financial year.
Thank you. I'll be honest, the questions have kind of stopped. Some have come through, but I believe they're being typed as well, already answering them because they've come through. For anyone that is joining us here today that still has a question, please firstly remember that CareSuper does have a dedicated Payday Super webpage on the CareSuper public website. So it is where this video will be uploaded. We've got some Q&A function down the bottom with common asked questions, which we will keep updating as we explore more and get those questions from our employers. We can start using this page as a dedicated touch point for anyone here today. But it's also really important to remember that we are here to help. We've got a dedicated team that are here to support you and your team, whether that's contacting your relationship manager directly or your business development manager. We are here. And if you've got these questions, absolutely reach out to us. But Shane, I really want to thank you for giving up your time today. It's been a great insight into not only the changes that are coming, but just how complex some questions that we've come through can be, but also how we can get that information and maybe not overcomplicate some things, or maybe we need to investigate a little bit harder. But Shane, I really do appreciate you giving up time today. It's been absolutely insightful for myself as well as the audience, I can imagine. I can see some comments coming through saying thank you, thank you. But for everyone joining us here today, again, thank you also for giving up your time today. So my name's Justin Miles. I'm one of the education specialists here at CareSuper. Thank you, Shane, and thank you to everyone that's joined us here.
Thanks for having me, Justin. Thanks, everyone.
Thank you.